Hello wizards! Welcome to another video of the Academy, where you will learn about monetary policies, global liquidity flows, and macroeconomics. Today, we take a look at the EFFR versus SOFR spread chart, which we call US collateral demand in the dashboard. Let's get straight into it. Okay, so here in purple, you can visualize the spread between these two benchmark rates, which is calculated by subtracting the secured overnight financing rate, or SOFR, from the effective federal funds rate, or EFFR. Down here, you have a pretty convenient explanation of how these two rates work and what they're used for. Let's get through it together. The EFFR is an interest rate at which banks lend or borrow money overnight in between each other, usually on an under-collateralized basis, and it's the target rate for the Federal Reserve's monetary policy. It's basically the cost of money for a bank when the lender is another bank inside a federal funds market, which is precisely an interbank market for lending and borrowing cash overnight, typically to meet regulatory reserve requirements. It can be thought of as the IORB plus a small additional spread because the IORB is the least amount of returns that the banks can have by depositing their excess reserves at the Fed, as we explained in our last video. And the spread, that would be influenced by the funding conditions of banks, so actual demand for those reserves. SOFR instead is an interest rate based on the cost of borrowing cash overnight in the repo market, as we also explained in its own episode, where transactions are collateralized by Treasury securities. Keep in mind this collateralized versus uncollateralized distinction that there is between these two rates, because it's a key point. By the way, SOFR can be viewed as the repo award rate plus an additional spread from the tri-party rate, which is also related to the balance of cash versus general collateral in the repo market, plus another small spread caused by the actual trades. So, in essence, the presence or absence of collateral securing the transactions is the main difference between these two rates. This is because the federal funds rate is not affected by fluctuations in the supply of collateral, because the transactions in the federal funds market are uncollateralized, while in the repo market, each transaction is collateralized by some security, so SOFR is particularly sensitive to changes in the actual supply and demand for collateral, especially T-bills, which are regarded as the best type of collateral because they are non-volatile in nature. Effectively, our chart takes advantage of this dynamic to show you the balance between cash and collateral in the system. When the spread between SOFR and EFFR is positive like it is at the moment, meaning that SOFR is smaller than the federal funds rate, it indicates a surplus of cash in the system and a shortage of collateral. While, when the spread is negative, the opposite is true, and it suggests a shortage of cash and a surplus of collateral in the system. This is useful to grasp real demand for a US Treasury in the economy, particularly when it comes to collateralizing derivatives products or foreseeing a potential collateral crisis. As we've talked about in the TGA video, the minting of different types of Treasury securities can have a different impact on liquidity and different outcomes on the global markets. US collateral demand is also useful to be looked at from the perspective of the banking sector's potential obligation to purchase this asset class that, as we know, could cause a liquidity spike by inflating the money supply. Overall, monitoring this metric is a compelling way to gain insight into the well-being of the financial sector and the health of the treasury markets in the United States. So, keep an eye on it. Thank you for watching, Wizard. Once again, remember to subscribe and turn on the bell icon to support us, and if you don't want to miss out on the next videos.